We recognise that when investors are allocating to fixed income, they're looking for predictable outcomes when it comes to things like capital stability, liquidity and income. And so when we lend to companies, we're looking for companies which exhibit similar characteristics. When investing in corporate debt, you've got to be cognizant that it has an asymmetric risk profile. And by that I mean the returns are characterised by a high probability of frequent but modest positive returns and a low probability of infrequent but large negative returns. So one of the biggest value adds when investing in credit is to screen out that downside risk. At Perpetual, there's three ways we look to screen out that downside risk. The first one's diversification. Secondly, active portfolio management. And finally, applying quality filters to our investable universe. In regards to diversification, typically we hold 1 to 200 securities within the portfolio. When it comes to active management, we're actively looking to invest where risk is best rewarded. In applying the quality filters, we're looking to lend to companies which have strong management, stable balance sheet, predictable earnings, are leaders in their industry sector, and companies which have a low susceptibility to event risk, whether that's regulatory or political. When investing a short duration portfolio, the securities in the portfolio are primarily floating rate securities. And what this means for investors is that they can benefit from a rising interest rate environment in terms of the extra income that's generated in that environment. It also acts as a good inflation hedge for the same reason. And finally, the capital price of the securities has a very low sensitivity to changes in interest rates, so you get capital stability. And when investing in high quality credit, generally history has shown that credit spreads overcompensate you for default risk, and again it generates those risk controlled and predictable outcomes for investors. Typically we've avoided lending to companies in the airline sector or companies with long-tailed insurance risk, because these companies don't tend to have those predictable outcomes investors are looking for when they allocate to fixed income. On the positive side, recent changes to global banking regulations have meant that banks have had to hold more capital and more liquidity, and whilst this could be negative from an equity holder's point of view, from a credit investor's point of view, it's actually increased the capital buffer protecting debt investors. Historically, high quality credits have overcompensated you for default risk in terms of the credit spreads they offer. And along with our active management and proven investment process through many market cycles, we believe we can continue to deliver for investors.